Okay, let's unpack this. Imagine a tiny, struggling public company just sort of barely holding on,
Right.
and then suddenly, boom, it announces it's becoming the vehicle for this massive, really ambitious new player.
Yeah, backed by some pretty high-profile names, too, aiming to dominate well, a red-hot industry.
Exactly. That's the drama that's been unfolding with Griffin Digital Mining, ticker GRYP.
And the market reaction, just extreme volatility. Anyone watching GRYP saw that stock price just, shoot up like crazy after the news.
Absolutely wild swings, from cents up to nearly $3, then pulling back fast. It's been quite the ride.
Definitely.
So today we're doing a deep dive into Griffin Digital Mining and this, well, potentially transformative reverse merger with American Bitcoin Corp, or ABTC. We've pulled together analysis based on the articles and research you, our listener, provided. Our mission, really try to cut through the noise and understand what this means if you're looking at GRYP stock, or, more accurately, the future ABTC.
Yeah. At its heart, it's really the story of a, let's face it, failing public vehicle being taken over by a very, very ambitious private group.
A group with significant backing and a huge goal.
Monumental, you could say.
Now, if you find deep dives like this valuable, helping you get informed quickly, thoroughly remember to subscribe to Stock Analytics AI on YouTube. We really enjoy digging into these complex stories.
We do. And for our $4.99 a month members, you can even give us a ticker you're interested in, and we'll prioritize a deep dive and analysis just for you.
Yeah, it's a great way to get the insights you need faster.
So as we go through the source material today, we'll keep circling back to a core question, I think.
Okay.
Which is, can this new combined company actually pull off building the world's largest, most efficient, pure-play Bitcoin miner? Or is it just, given all the challenges, a highly speculative bet?
That really is the big question, isn't it? We'll share some final thoughts on that provocative idea right at the end, so stick around.
And all the sources we're talking about are linked down in the description so you can check them out yourselves.
All right, let's dive into the first half. We should probably start by understanding the businesses involved, right? Beginning with GRYP before all this merger news hit.
Right. So Griffin Digital Mining, founded back in 2020, basically a U.S.-based Bitcoin miner operating in places like Nevada.
Pretty standard stuff.
Pretty standard. Their business was, mining Bitcoin, using those specialized computers, the ASICs.
Machines built just for Bitcoin mining.
Exactly. And they earned revenue from the mining rewards, the new Bitcoin they created, plus transaction fees. Straightforward.
But they really pushed their image, didn't they? The sources talk a lot about this 100% renewable energy focus.
Oh, yeah, big focus. Aiming for carbon neutrality, claiming these incredibly low power costs. What was it? Around 1 cent per kilowatt hour?
Yeah, which sounds almost too good to be true in mining. And they had independent ESG verification. That was definitely their public face.
It was. They also sort of mentioned being in the Bitcoin and AI space. But honestly, looking at the source material you sent over,
not much there on the AI front.
Very little concrete detail. No real AI-specific revenue mentioned. No significant operational use of AI detailed. It really looked like overwhelmingly a Bitcoin mining operation.
Okay, and they had that kind of unique deal, that asset-light strategy with Sphere 3D.
Ah, the royalty agreement. Yeah, it's supposed to give them a 22.5% cut of gross profit without owning the machines themselves.
But that didn't quite pan out, did it?
No, the sources indicate that went south. There was a termination dispute, and looking at their recent financials, like Q1 2025's, barely any receivables related to that deal. It just didn't deliver.
Which really just highlights how precarious their standalone situation was.
Exactly. Now let's contrast that with American Bitcoin Corp, ABTC. This is the entity basically taking over through the reverse merger.
The new player on the scene.
Right. Formed early 2025. It's a strategic initiative by Hut 8 Corp.
Who are a pretty big name in North American mining and infrastructure.
They are. Hut 8 plus a group of investors, including the name that got a lot of press, Eric Trump.
Right, the high-profile involvement. So Hut 8 essentially seeded ABTC with a bunch of its own mining machines.
That's right. Contributed the majority of its wholly owned ASICs to get ABTC started, initially taking an 80% ownership stake.
And their mission statement is not subtle.
No, it's incredibly explicit and ambitious to build the world's largest, most efficient, pure-play Bitcoin miner. Full stop.
Wow. And their strategy.
Large-scale, low-cost Bitcoin accumulation, building up a big strategic Bitcoin reserve.
And Hut 8 isn't just an investor here. They're sticking around operationally.
Yep. They're lined up to be ABTC's exclusive infrastructure and operations partner through long-term agreements, so very tightly linked.
Okay, so why use GRYP then? Why this reverse merger, this RTO?
Speed, mostly.
Right.
It gives ABTC much faster access to the public capital markets compared to a traditional IPO.
And they need that capital badly for growth.
Desperately. They have huge ambitions, and the plan, according to the sources, is clear. Reinvest 100% of that growth capital directly into buying new, efficient ASIC hardware.
Okay, that paints a really clear picture. Failing company becomes shell for ambitious, well-backed new venture needing lots of cash.
That's the essence of it.
So who are the people actually going to be running this new ABTC? Let's look at the management team.
Right. The leadership is coming entirely from the ABTC side. You've got Mike Ho as executive chairman. He was chief strategy officer at Hut 8, co-founder and former CEO of US Bitcoin Corp. Deep mining roots back to 2014.
Life experience.
Then Matt Prusak as CEO. He was previously head of Ionic Digital Mining, also a former USBC exec, background at Bain & Company too.
And Eric Trump, his role.
Chief strategy officer. The sources suggest he's expected to bring, commercial acumen and capital markets expertise, leverage his network, presumably.
Makes sense. And the board.
Also stacked with ABTC Shed 8 connections. Asher Janut, who is the current CEO of Hut 8 and another co-founder, former president of USBC, he's on the board.
So very interconnected with Hut 8.
Very. Plus some other interesting names mentioned on the board, like Justin Mateen, co-founder of Tinder.
Oh, interesting.
And Michael Brokum, co-founder of FabFitFun. So a mix of mining ops, finance, and maybe broader tech consumer backgrounds.
So you've got that hands-on mining experience from the USB Such 8 side, blended with capital markets and other business experience. What about their track record, especially in the public markets?
Well, the core operational team certainly has experience scaling mining ops. That's a plus. However, it's worth noting, Matt Prusak's previous role at Ionic Digital.
What happened there?
Their planned IPO got delayed after their auditor withdrew. Now, Ionic stated it wasn't due to any accounting disagreements, but
it's still something that catches your eye, right?
Right.
Especially when using an RTO like this.
Exactly. It just adds a layer of attention needed regarding public market readiness. And maybe adds context. Hut 8 itself, the parent partner, reported a pretty hefty loss, $134 million in Q1 2025.
Ouch. Shows how tough the environment is even for established players.
It really does. Very challenging right now.
So looking at this from a value investing angle, thinking about alignment with shareholder interests, how does ABTC's plan look?
Well, the strategy is laser focused on growth through reinvestment. Tap public markets, buy ASICs, scale up mining capacity rapidly. That's clear.
And the strategic Bitcoin reserve, holding on to the Bitcoin they mine.
Yeah, that's an interesting one from a traditional value perspective. Holding Bitcoin itself is often seen as more of a speculative act. Value investors typically prefer seeing capital returned via dividends or buybacks or reinvested in projects with very clear high rates of return. Holding the commodity itself is different.
And who's driving the strategy?
Look, the legacy ABTC shareholders end up owning roughly 98% of this new combined company. So their interests, their strategy, they are overwhelmingly driving the bus here. The original GRYP shareholders are very much in the backseat.
Makes sense. And the governance structure, you mentioned the Hut 8 connection is strong.
It's fundamental. The board is drawn from ABTC. Hut 8 isn't just the initial majority owner, they're the exclusive operational partner, and their CEO is on ABTC's board.
So potential conflicts of interest.
Definitely potential. That structure really demands robust, independent oversight to protect all shareholders, especially that minority 2% from the old GRYP. And it's worth remembering, the sources mentioned Griffin itself had prior issues flagged regarding director independence, so governance is absolutely a critical area to watch for the new ABTC.
Got it. Okay, let's pivot to the cold, hard numbers, which for GRYP on its own told a pretty stark story.
Stark is putting it mildly. Severe financial distress is probably more accurate. Looking at their history from the sources, revenue was just collapsing.
Like how bad?
Q1 2025, just $1.56 million. Compare that to $7.485 million the year before, Q1 2024. Huge drop. Full year 2024 revenue was only about $20.5 million.
And profitability, or lack thereof.
Just deep, consistent net losses. They lost $6.28 million in Q1 25 alone, over $21 million lost in the full year 2024.
Wow, and the margins must have been terrible.
Disastrous. Sources show negative 108% net margin, negative 137% operating margin for FY24. And maybe the most shocking, Q1 2025 showed a deeply negative gross margin, over 100% negative.
Hang on, negative gross margin, how does that even work?
It means for every dollar they made selling the Bitcoin they mined, their direct cost just to mine, that Bitcoin, mostly energy and maybe hosting, were more than $2.
So they were losing money just turning the machines on before even paying salaries or anything else.
Exactly. Fundamentally unprofitable at the operational core. That's bad.
And that shows up in their break-even cost, right?
Yeah, a key metric showing the pain. Their cost to break even on mining one Bitcoin reportedly surged to over $75,000 in Q4 2024.
Which at many points was way higher than the market price of Bitcoin?
Precisely. They were spending significantly more to mine a coin than they could sell it for. Unsurprisingly, cash flow from operations was negative. Free cash flow was negative.
Yeah.
They were just burning cash.
Relying on financing to survive.
Completely. And the balance sheet just confirms the dire straits.
Yeah.
A significant stockholders deficit.
Can you break that down? Stockholders deficit.
Simple terms. Their total liabilities, everything they owed, were greater than their total assets, everything they owned. Their net worth as a company was negative.
By how much?
Over $7.6 million negative equity as of March 31st, 2025. At about $5.5 million in debt on top of that, and liquidity was incredibly tight. Current ratio was just 0.24.
And a 0.24 current ratio means?
It means they only had about 24 cents in cash or things easily turned into cash for every dollar of short-term bills coming due soon. That's dangerously low. Signaled less than a year of cash runway at their burn rate.
Yikes. And ROIC, return on invested capital.
Problematic, negative historically. Any weird positive blips you might see in some sources are likely just calculation quirks because of that negative equity, not real returns.
So this was a company truly on the brink.
Absolutely. Which helps explain why the GRYP shareholders are only getting that tiny, roughly 2% stake in the merger. Their main contribution really was just providing the public listing shell.
Right. Now for ABTC, the new entity, doing a detailed financial forecast sounds, well, almost impossible right now.
It's incredibly difficult. It's a brand new company, no standalone public history. The merger isn't even finalized. Any projections are based heavily on future targets.
Which they might not hit.
Exactly. And huge assumptions about things they don't control, like Bitcoin price, network difficulty, energy costs, and crucially, those new tariffs we need to talk about later. It's highly speculative to try and model detailed financials accurately right now.
Okay, but we can talk about the drivers, right? What could drive revenue for ABTC?
Sure. Primarily, it's just the sheer amount of Bitcoin they mine. That's a function of their total computing power, their hash rate, measured in exahashes per second, EHs.
How many machines they have running and how powerful they are.
Right, plus their energy efficiency, how much power they use. Then there's the network difficulty, basically, how much competition is out there from other miners globally. And, of course, the current Bitcoin block reward, which just got cut in half recently.
Any other big driver?
The market price of Bitcoin itself. Hugely sensitive to that. Transaction fees are usually a smaller piece of the pie.
Okay. And their projected costs, what are the big ones?
Energy. It's the elephant in the room for all Bitcoin miners. It's incredibly power hungry. Their costs will depend massively on the power deals Hut 8 has secured, since Hut 8 is their exclusive operator.
And they're emphasizing low-cost power, but what does that actually mean in context?
Well, for comparison, the sources mention competitors like Riot Platforms reporting around 3.7 cents per kilowatt, Cypher mining around 2.7 cents. ABTC needs to be in that ballpark, or ideally, lower to be truly competitive long-term.
What else?
Depreciation. They're buying potentially billions of dollars worth of ASICs over time. That equipment loses value fast, so depreciation will be a huge non-cash expense on the books. Plus, the infrastructure operating costs paid to Hut 8, and then standard G&A, public company costs, salaries, admin.
So how are they funding this massive growth plan? They want to get to over 50 EHs, you said?
Yeah, 50 plus EHs is the target mentioned. That requires enormous capital expenditure, CapEx.
How much do they start with?
Hut 8 contributed about 9.3 EHs worth of ASICs to start ABTC. But getting from 9.3 to 50 plus, that needs massive new investment.
And that's where the public listing comes in.
Exactly. Accessing growth capital from public markets is the whole point. Funding will likely come from selling new shares.
Which means potential dilution for existing shareholders.
Right. Your slice of the pie gets smaller. Or they could take on debt, which adds financial risk. Their stated plan is aggressive. Reinvest 100% of growth capital into ASICs.
But holding that Bitcoin reserve could complicate things.
It could. If they hold on to a lot of Bitcoin instead of selling it immediately, That ties up cash that could otherwise be used for reinvestment, potentially making them more reliant on external funding, like selling stock or taking on debt.
Okay. And profitability. It sounds incredibly leveraged.
It is highly sensitive to Bitcoin price and energy costs. Achieving their target efficiency, they're aiming for less than 15 joules per terahash, 15 JTH.
Which is a measure of power efficiency, lower is better.
Right? Lower JTH means you use less electricity for the same amount of mining work. Hitting that kind of efficiency target is absolutely critical, especially after the halving cut rewards and with costs potentially rising due to tariffs.
Can you give an example of the sensitivity?
The sources had an illustrative table. Just as an example, it showed if they hit 50 EHs and their energy cost was, say, 0.25 centiwatts, their gross profit could swing wildly, maybe around $207 million if Bitcoin's at 50K, but jump to maybe $451 million if Bitcoin hits 75K.
Wow, that's a huge difference based just on Bitcoin price.
Exactly. And that simplified doesn't account for difficulty changes or everything else. It just shows how volatile the potential outcomes are based on factors largely outside their control.
It really underscores the inherent volatility in this business model. Okay, let's shift gears into the second half and talk about market sentiment around GRYP. How did analysts see it?
Well, for GRYP itself, coverage was pretty thin, which isn't surprising for a struggling microcap. H.C. Wainwright had a neutral or hold rating.
I saw one mention of a really high price target, like $16.
Yeah, there was one analyst target like that mentioned, but honestly, given GRYP's awful financial state and the fact that its shareholders are only getting about 2% of the new company,
that target seems disconnected from reality.
It likely either predates the full merger details becoming clear, or it's based on incredibly optimistic, purely speculative assumptions about what ABTC might achieve way down the road. Analyst focus is going to completely shift to valuing ABTC once this deal actually closes.
Okay. What about the options market? Any clues there?
The sources didn't have detailed options activity data for GRYP around the merger announcement time, unfortunately. But given the massive price swings we saw,
any options trading would have been purely speculative anyway.
Almost certainly. Without specific data on volume or open interest, it's hard to draw firm conclusions about sentiment from options here.
Right. Short interest, though. That seemed to tell a more interesting, maybe complex story, especially with that price spike.
It did. On the surface, the short interest percentage, the number of shares shorted compared to the total available to trade, was actually pretty low, around 1.6% according to the sources.
And days to cover was tiny, like 0.05 days.
Yeah, very low, which usually suggests shorts aren't heavily dug in and could cover their positions really quickly if they needed to.
But that short borrow fee rate was insane. Sources showed rates over 80% in late May. What does that signal?
That incredibly high fee is the interest rate short sellers have to pay just to borrow the GRYP shares they want to sell short. An 80% plus rate means it became extraordinarily difficult and expensive to borrow GRYP shares after the merger news and the price jump.
So hard to bet against it, even if you wanted to.
Very hard and very costly to maintain a short position. Now, combine that high borrow cost with what the sources showed on daily short volume ratio.
That was high sometimes, right? Over 60% on some days.
Exactly. Even on off-exchange trading venues. That means on those really volatile days, a huge chunk of the trading was short-selling activity, likely day traders trying to capitalize on swings. But the high cost probably prevented large, persistent short positions from building up.
So what's the takeaway?
It suggests a dynamic prone to volatility and maybe potential short squeezes, where a rising price forces shorts to buy back shares, pushing the price even higher, even though the overall percentage of shares shorted remained low. It was just too expensive to stay short for long.
Interesting dynamic. Okay, let's look at who owned GRYP before the merger. Insiders first.
Insider ownership was reported as pretty significant, somewhere in the range of 28% to maybe 39%, depending on the source data point. Key holders included Anchorage Lending. They were a 10% owner and had a board seat, and the CEO, Stephen Gutterman.
And there was that really striking pattern of insider selling right after the merger news and the price spike. That seems important.
This is definitely a data point that jumps out. The sources specifically mentioned Director Daniel George Tallhurst selling a lot of shares, over 2.78 million in May 2025.
At what prices?
Between $1.30 and $1.45. Right after the merger announcement caused that huge price surge from well under $1.
And that contrasts with the earlier activity.
Yeah, there were some insider buys mentioned back in January 2025, but down at 3.39. So buying low, selling high, right after the big news.
How does a value investor typically view that kind of selling?
From a traditional value investing perspective, significant selling by an informed insider immediately after a major positive news event causes the price to spike. It's often seen as a negative signal.
Why?
It can suggest that the insider perhaps believes the stock price got ahead of itself, maybe thinks it's become inflated, or that the future risks are still very high despite the good news. It raises questions about their conviction in the long-term value at that new higher price.
Okay, definitely something to note. What about institutional ownership? The big funds, the asset managers.
That was quite low for GRYP, around 3.36% according to the sources, which is pretty normal for speculative microcaps, especially ones that were struggling financially like GRYP was.
Any big names holding small positions?
You see some recognizable names listed: Murchison Ltd., Cambridge, Hudson Bay, UBS, BlackRock, but their individual holdings seemed relatively small.
And for the new ABTC, they'll need institutions, right?
Oh, absolutely. To fund those massive growth plans, to get broader market acceptance, maybe achieve some price stability, they will absolutely need to attract significant institutional capital.
And what will that take?
It'll require ABTC to actually deliver, demonstrate tangible progress on their build-out, execute well, hopefully show a path to profitability, and definitely establish strong, transparent governance that institutions can trust.
Okay, let's move to the final big section before we try to tie it all together. Risk assessment. This whole venture, even with ABTC's ambition and backing, sounds incredibly risky.
It is. The risks are layered deep, starting right at the company level for the new ABTC. There's just immense execution risk, meaning actually achieving that target of 50+ EHs and hitting that ultra-efficient 15 JTH energy usage. That is a monumental task for a brand new entity. It requires flawless execution on deploying potentially hundreds of thousands of machines, securing power, managing operations at massive scale. So much can go wrong.
And the financial viability, the need for capital.
Huge risk there, too.
Yeah.
We talked about the massive capex needed. That brings the high likelihood of future shareholder dilution from selling more stock or taking on lots of debt, which adds its own risks. They need to become profitable quickly to help self-fund some of that growth.
Other company-specific risks.
Yeah, the heavy reliance on key personnel, particularly from that ABTC Chet 8 leadership group, and the success and crucially the terms of that exclusive partnership with HUT 8. Is it truly favorable long-term? Then there's the baggage of GRYP's legacy as a failed public company and just the sheer share price volatility we've already seen that's likely to continue.
Okay, what about broader industry risks, just being in the Bitcoin mining space?
Oh, plenty of those. Bitcoin price volatility is number one. It can change your revenue and profitability dramatically overnight based on market swings you can't control.
Network difficulty.
A constant grind. As more miners join the network globally, it gets harder and harder to mine each Bitcoin. You need to constantly upgrade your hardware just to maintain your share of the total network hash rate, let alone grow it.
Competition.
Intense. You're up against huge, established, often very efficient miners all over the world. It's a global arms race for efficiency and low-cost power.
And the hardware itself.
Rapid obsolescence. The ASICs you buy today, even the top-of-the-line ones, will likely be significantly less efficient than new models coming out in 12-24 months. So you're constantly needing to reinvest huge sums just to stay competitive.
And
the absolute lifeblood. Securing long-term, reliable, low-cost power is maybe the single biggest operational challenge. Energy prices can be volatile, availability can be an issue. It's critical. And future Bitcoin halving events, like the one recently, will continue to cut the mining reward, putting even more pressure on margins over time.
regulatory risks always loom large in crypto, too.
Yeah, absolutely do. The U.S. regulatory environment is key for ABTC. While some sources mention maybe more pro-crypto signals recently from the current administration, policies can change fast.
And global actions matter, too.
Definitely. What happens in other major regions can impact the whole ecosystem, market sentiment, everything, and there's still just a general lack of legal clarity around many aspects of crypto, which creates ongoing operational uncertainty for businesses in the space.
Now let's dig into this specific, significant new factor, the U.S. tariffs imposed in 2025. This sounds like a major curveball for U.S. miners like ABTC.
It's a really big deal, especially for a company planning such a massive hardware build-out in the U.S. right now. These tariffs hit imported mining hardware, specifically ASICs, maybe GPUs too.
How much are we talking?
They start at 10%, but the sources say they're scheduled to escalate significantly, maybe to between 24% and 36%, on goods coming from major manufacturing countries, which is where almost all ASICs are made.
Wow. So how does that directly impact ABTC's grand plan?
It directly and substantially increases their capital expenditure. Their main cost is buying ASICs. If those ASICs suddenly cost 24% to 36% more purely because of tariffs, that's a massive hit.
Can you put a number on that?
The sources use a simplified example. Imagine a $4,000 ASIC. The tariff could add $1,000 to $1,400 extra to its cost. Now multiply that by the tens or hundreds of thousands of new machines ABTC needs to buy to reach 50-plus EHs.
You're talking potentially hundreds of millions in extra costs.
Potentially. Hundreds of millions of dollars that don't buy them a single extra terahash of mining power or a single joule per terahash improvement in efficiency. It just makes everything more expensive.
That seems like a gigantic headwind for achieving those scale and efficiency goals they're targeting.
It absolutely is. It directly eats into their potential profit margins. It erodes the return on invested capital, ROIC, they can possibly achieve from buying all this new hardware. It makes the economics much, much tougher.
Any other impacts from the tariffs?
Yeah, potential supply chain disruptions too. The sources mentioned possible delays of 2 to 6 months in getting machines, plus maybe additional frictional costs of 1–2%. Just adds more hurdles.
Is there any wiggle room? Like, are ASICs definitely covered?
There's apparently still some ambiguity mentioned in the sources about whether fully assembled ASICs might qualify for some kind of semiconductor exemption, even though they contain lots of chips. The final clarity wasn't definitive yet based on the material we reviewed.
And the broader economic impact?
Also projected to be negative, according to the sources. Could hurt U.S. GDP, raise consumer prices, potentially even contract the U.S. mining sector overall. While maybe long-term, it could incentivize some domestic production.
That doesn't help ABTC now when they need the machines.
Exactly. Not a near-term solution for their immediate, massive hardware needs.
Okay. And finally, just general market risks.
The usual suspects. Economic downturns can just crush investor appetite for speculative assets like crypto miners. And overall investor sentiment towards crypto itself can swing wildly based on news, regulation, macro factors, causing sharp, unpredictable moves in related stocks like ABTC will likely be.
Okay, so let's try to bring all of this together now. We look at this whole GRYP becoming ABTC situation through a traditional value investing lens, thinking about principles associated with someone like Warren Buffett. What's the assessment?
Right, let's try to break it down using that framework. First, GRYP standalone.
Easy one.
Pretty easy. Clearly a failing business based on the financials. No durable earning power, essentially negligible intrinsic value. Using it as a public shell was likely its only remaining option to provide any potential value path for its shareholders.
Okay. How about the business model of the new ABTC, the Bitcoin miner?
Well, the mechanics are understandable, right? You buy machines, plug them in, use electricity, produce Bitcoin. But from a value perspective, the economics are just so heavily tied to those external volatile factors we discussed. Bitcoin price, network difficulty constantly rising, energy costs fluctuating. And the core asset, the mining hardware, becomes obsolete incredibly quickly.
So questionable durability, no moat.
Exactly. That concept of a durable competitive advantage, a moat, is really hard to see here long term. Can they really build a lasting moat just based on scale and efficiency when the hardware technology changes every 1–2 years and everyone else is chasing the same low energy costs? It's questionable.
What about the management team?
The operational experience from USB SHIC 8 is a positive starting point, definitely. But the combined ABTC team doesn't really have a public track record managing an entity at the massive scale they're envisioning yet. Governance needs real scrutiny, especially with those deep Hut 8 interdependencies and potential conflicts.
And the insider selling?
Yeah, that GRYP insider selling right after the price spike.
Yeah.
That's certainly a concerning data point if you're looking for signs of strong management conviction in the long-term value proposition.
Okay. Financial strength and trying to figure out an intrinsic value for ABTC.
Well, ABTC starts with some contributed assets from Hut 8, but it needs absolutely massive future funding to hit its targets. Trying to calculate a reliable intrinsic value for this new entity right now, it's just too difficult, bordering on impossible from a strict value perspective.
Why? Too many unknowns.
Way too many huge uncertainties. What will Bitcoin's price be? What will their actual long-term energy costs and efficiency metrics look like?
Yeah.
Will they successfully execute this incredibly ambitious build-out?
Yeah.
What's the full long-term impact of those U.S. tariffs going to be?
Okay.
And what about the inevitable future dilution or debt needed to fund it all? You just can't pin down reliable numbers for those key inputs.
So if you can't reliably estimate intrinsic value,
then you absolutely cannot establish a clear margin of safety, which is fundamental to value investing, right? buying something for significantly less than you conservatively estimate it's worth to protect yourself if things go wrong.
And that margin of safety isn't visible here.
Based on the sources and the current uncertainties, no, not from a traditional value investing viewpoint. There's no anchor of proven, durable earnings or assets to compare the price against confidently.
Which brings us back to the price versus value question for GRYP BTC stock.
Exactly. GRYP's recent price spike clearly reflected speculative excitement about ABTC's potential future, not GRYP's practically non-existent historical value. The actual value of that roughly 2% stake the GRYP shareholders are getting hinges entirely on whether ABTC can successfully navigate all those massive risks we laid out and actually achieve its incredibly ambitious goals. It's purely a bet on future success, not current, demonstrable underlying value.
So the concluding thought from this deep dive, based on the sources.
Looking at it through that strict value investing framework, GRYP becoming ABTC at this stage appears highly speculative. It fits much more comfortably into a venture capital or maybe an aggressive growth investing profile.
Where you accept high risk for potential high reward.
Right. You acknowledge the potential for huge returns if they succeed, but you also acknowledge the very significant risk of substantial, maybe even total, capital loss if they fail. A traditional value investor would likely stay on the sidelines here.
What would they wait for?
They'd want to see ABTC actually prove the model, demonstrate consistent profitability, ideally through different Bitcoin price cycles, show effective, independent governance in practice, and then maybe offer shares at a price that provides a significant discount to a conservatively estimated level of durable earning power, none of which is clearly visible right now based on the sources.
And there's our hook reveal, I suppose. The extreme ambition of ABTC's targets, measured against the incredibly high risks they face, especially those new U.S. tariffs adding massive cost, the monumental execution hurdles, and just the inherent volatility of the whole Bitcoin mining industry.
Yeah. It makes this story, based on the sources we have, either a potentially transformative, huge success story if they pull everything off perfectly, or a very capital-intensive, incredibly difficult uphill battle with really no clear margin of safety currently visible for that traditional value investor.
It's definitely a high-stakes situation to watch unfold.
No doubt about it.
Well, if you want more deep dives like this one, helping you cut through the noise and understand complex market situations based on the source material provided, please remember to subscribe to Stock Analytics AI on YouTube.
And check out that $4.99 a month membership if you want prioritized analysis on the specific tickers you're following most closely.
Okay, before we wrap up, the important disclaimer.
Yes. As always, this deep dive is strictly for informational purposes and based solely on the provided source material. It does not constitute financial advice. Investing in stocks, especially microcaps and highly volatile sectors like Bitcoin mining, carries significant risk, including the potential loss of your entire investment. Past performance is not indicative of future results. Conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions. This analysis also relies on AI processing of the provided text, and while we strive for accuracy based on those sources, information can be subject to interpretation and market conditions change rapidly.
Thanks for joining us for this deep dive. We'll see you on the next one.